Welcome to the Steering Change Podcast, navigating through the commercial transportation industry in Alberta and beyond, powered by the Alberta Motor Transport Association. Here's your host, Kelsey Hipkin.
Hello, friends, and welcome back to Steering Change. Today, we're diving into a topic that's important for every carrier ownership group, regardless of whether you're planning to retire next year or 10 years from now, succession planning. Too often, succession is viewed as something you only think about when it's time to sell your business. In reality, the strongest companies are building a plan years in advance, whether that's preparing the next generation of leaders, transitioning ownership internally, or positioning the business for a successful acquisition. Joining us today is Sean MacLachlan, partner with MLT Aikins, who works with industry in helping them navigate these important transitions. We'll discuss when owners should start planning, what buyers and successors are looking for, common mistakes that can reduce business value, and practical steps owners can take to protect both their people and their legacy. Sean, welcome to the show.
Well, thanks very much, Kelsey. I'm happy to be here.
Thank you. We're going to do an easy one to start. Tell us a bit about yourself and the work that you do with MLT.
Yeah, I am a partner at MLT Aikins, which is one of the largest law firms in Western Canada. I'm a corporate lawyer at MLT, and a important part of my business or my practice is working with business owners, and I work with a number of trucking and logistics companies, and working with them on succession and sale transactions. And that encompasses a number of things. It could be a straight sale transaction to an external buyer. It could be a merger with another company, or it could be a succession plan where the business is being transferred to family members or to key members of management or key employees, and structuring that type of a transaction and the governance arrangement or framework that needs to go with it.
Amazing. Thank you. And that succession piece is what we are going to dig in today. So, Sean, when should carriers start succession planning, whether internally or preparing for an eventual sale?
That's a great question. And the truth is that it often should happen a lot sooner than most business owners think. Mm-hmm. I typically tell clients to start thinking about transition 3 to 5 years before they plan to step back from the business or to retire. Often we are given scenarios that are more like 3 to 5 months. But the truth is that a longer runway can be very helpful. And there's a few reasons for that. Mm-hmm. The first is that there is a corporate cleanup exercise that is typically required, getting financial records in order, getting corporate processes and safety and compliance records all cleaned up so that they can be presented to a new buyer or to be presented to the new management team that's going to take over the business, and have confidence that there are no sort of skeletons that are hidden in the closet. The idea is to find the weaknesses and to be able to either address them or to be able to explain them so that mm-hmm. they don't cause surprises and don't cause concern or anxiety in the transition process.
Yeah, the paperwork must be pretty extensive.
It can be, yeah. And it often will take years, not months, to mm-hmm. clean up. And another reason is that there's sort of a people prep exercise that often needs to be done, particularly when there's an internal succession plan in place, and that could be because the team or the person taking over might need to have some leadership development, might need to have better introductions or even introductions to key customers, may also need to develop some credibility with personnel in order to make sure that the transition can run as smoothly as possible. And those that relationship building also tends to take a longer time, like mm-hmm. often over a series of years, not so much a series of months or a single meeting where there's a handshake and a goodbye. And a third reason that a longer runway can be really helpful is from a tax and estate planning perspective. And in these types of transactions, there is often tax planning that can be done in order to mitigate or defer taxes that will need to be paid or would need to be paid at closing of the transaction. Mm-hmm. And that tax planning exercise can itself take quite some time in order to evaluate and get in place. And then also there are frequently statutory timelines that need to be followed once the changes have been made. Mm-hmm. That in a time period needs to elapse between when they have been made and when the succession or the sale actually occurs, and sometimes that's 2+ years. Oh, okay. So there's just a statutory reason why starting early can be helpful for tax purposes. And just as a general comment, I would say that from a succession planning or a sale planning perspective, it's often thought of as an event or a series of activities that need to be done. But in reality, the the most successful transitions will occur when the idea of this is more of a continuous discipline within the company, kind of at various times, just owners checking in with themselves and saying, hey, am I ready? If something came along or if some major event happened tomorrow, would the next generation be able to take over? Would I be able to get a sale process going relatively quickly and actually have the information my advisors will be looking for to help me with it? And so developing that internal discipline can be a really helpful exercise in order to promote success in the future.
So just kind of setting yourself a temperature check, whether it's twice a year, once a year.
Yeah.
Do I have these in place for the next steps?
Exactly.
So, Sean, you did kind of delve into this, but let's dig a little deeper. Succession isn't always necessarily about selling. Can you dive into kind of what a successful internal transition could look like? Yeah,
you bet. A successful internal transition, whether it's going to be to family or to a management team, usually has a few common ingredients. The first would be a written plan. It's important to be able to articulate, timelines, milestones, accountabilities, who's going to be involved. The second is having a phase transfer of both ownership and control. And those are two different things. One is ownership involves, where the profits are going to go, and control involves who's going to be making the decisions. And it is a common mistake to not transfer both, particularly in internal successions, to not transfer both at the same time. And that can cause a lot of confusion.
Okay.
And confusion is sort of the thing that will be the fastest way to cause problems and potential failure in the ultimate plan. So transitioning both at the same time is important, and phasing it over time is also an important element of a successful succession plan. Including developing a governance structure that is going to survive past the existing owner is also really important. And that can include a few things. If there's going to be more than one owner taking over, then having a well-articulated, well-drafted shareholder agreement to help with decision-making and share transfers if and when the time comes. Potentially expanding the board of directors or adopting or implementing an advisory board so that there's a set of skills and expertise that can help at a strategic level for the new owners. And also documenting policies. And, ultimately the objective is, if the business has been operating, as many do, with the owner being sort of the key ingredient and having all of the knowledge in their mind and doing a great job of managing the business as when they're involved with it, well, all that needs to come out and get transitioned down to other people within the business in order to help them manage it once the owner is not there. And that's sort of what we're looking for in terms of success. It's also important to get buy-in from the people who matter most. If it's being transferred to a family member and there are other family members that aren't going to be involved, important to get buy-in from them. Key customers, as well as key staff members that are going to be involved and they're going to be continuing. It's really important to get them on board with what the transfer is going to look like. And I'd say the last common ingredient or key ingredient would be having a funding mechanism in place.
Okay.
And even in a succession plan where it's going to transfer to new family members or to new management, the seller, the current owner, typically still needs to be bought out. And so having a way to make that happen is important. It might be external bank financing, it might be vendor financing, it might be an earnout, it might be a combination of all three of those, or even something else that everybody comes up with. But at the end of the day, those arrangements take time. And so it's important to get a plan in place and to make sure that there's an understanding on how the business owner is going to get paid out for their business.
Awesome. Thank you, Sean. So I've been with AMTA for 10 years, and it feels like the last couple years, we've really started to see a lot of carriers are buying other carriers, groups are buying other carriers. Can you touch on some of the biggest misconceptions owners might have about succession planning?
Yeah, you bet. I had a feeling you're going to ask me about that. And I would say that this is an area where I or we at the firm tend to hear particular phrases that come back to us, and so I thought I'd share a few of them today because I think it sort of highlights what can happen. And quite frankly, if you're a business owner and you're listening to this today and any of these resonate with you, just know that you're in good company. But at the same time, it is now is the time to reach out and have a conversation about how to change this narrative that you have in your mind. So the first one we hear regularly is, I'll deal with it when I'm ready to retire. and the reality is, as we've just been talking about, is it takes time to do this. And it's not just a switch you flip when it comes time to retire. There's a plan that needs to be put in place. The next one is, my kids or my manager will just figure it out. And, like, it's one thing to have passionate people working for your business. Yes. That's great. You need that. But having passion in the people who are going to transition in and take over the business is not enough. If they don't have the financial literacy, if they don't have the compliance skills, if they don't have the relationships with key customers, those are all things that need to be transitioned over time. And it is probably best to do it deliberately rather than sort of hope that you can make an introduction and they'll just like figure it out.
And I mean, you did mention a lot of these owners, they have the knowledge, the wherewithal, the processes, everything is just in their brain. So I imagine like mining that information. It's not on a Wednesday, I'm going to retire. On a Friday, peace out, I'm headed to the beach. So I imagine like the time that it must take to just gather all that knowledge and make sure that it's shared. Yeah,
that's exactly it. It is not a meeting that you schedule on Wednesday afternoon to say, I'm going to share everything I know about my business. Like it takes time. You might have dozens of those meetings over a period of time, but more so, you probably end up in a scenario where the person taking over starts to be more involved in the day-to-day activities that you are involved in. And so that they can learn a little bit by osmosis and a little bit by intentional or deliberate activity. And over time, that knowledge will pass over to the new owners. Another thing we hear fairly regularly is succession planning is only relevant if I'm selling. And the reality is that is not the case. As we've just been talking about, succession planning takes just as much planning and to implement a good framework in which to make it happen as a sale process. And another, and probably the last one that we hear regularly is, this is just a legal and tax exercise. And while I will admit that there is a legal and tax component to it, and a pretty important component, business owners are often surprised when encountered with this or going through it at what the emotional toll is that the process takes on them. When you think about it, a business owner that has developed a successful business that is ready to be transitioned will have invested years of themselves into making it a success. And so there will be a portion of their identity that is wrapped up in the business itself. There will also probably be some really important relationships to them, like loyal long-term employees, or perhaps relationships that they have with their children or with siblings or other family members that are involved in the business that organically occurred through the involvement in the business. And stepping back from that can cause quite a bit of an emotional turmoil for business owners, and that's a completely normal thing. But identifying it up front, and getting everybody aware of it so they can help manage it is, I think, a critical piece to the overall plan.
Absolutely. And I want to touch on that legacy piece some more in a minute. First, let's do the fun stuff. Let's talk about math. Not everyone's favorite, not my favorite, but how important is the financial reporting, compliance, documented processes during the due diligence of a succession change?
Well, they are critical. To put it bluntly, those are the areas that require a lot of time and attention. They're the areas where if they don't get time and attention, are the greatest threat of reducing the value of the business. And all of that can be avoided if enough planning is done and corrections are made before a formal process starts. From a financial reporting perspective, buyers and successors alike are going to want to see the financial statements. And particularly in external sale processes, buyers are going to ideally would see reviewed or maybe even audited financial statements instead of just management prepared financial statements. And buyers, again, whether it's through succession or through an external sale, will want to see a division of business expenses versus personal expenses. It's really normal for business owners to have some personal expenses running through the company. Maybe that's an unspoken truth that I'm not supposed to say in public, but it's true. And having your accountants go through, or your financial advisors go through and help make normalizing entries so that the true performance of the business is set out in the financial statements is a really important exercise to get done before the diligence process, so that you're not responding to questions and responding to things that a buyer is finding, because that is going to, in the buyer's mind, start to deteriorate the value of the business because there are these issues they know they're going to have to clean up. From a compliance perspective, your safety, fitness rating, compliance records, maintenance and inspection records, insurance claim history, those are all going to be scrutinized really closely. And so it's important to go through and make sure that they are clean, they are up to date, and that to the extent that there are issues that have been identified, that they are explainable, that you have a narrative around why it is that those occurred and what it is that you have done internally in order to address those problems. And so it's just a case of running out time before, for instance, ratings improve. And from a documented process perspective, it is the case that, as we were just talking about, business owners will very often have a lot of how the business works just in their mind, and how it is that it's always worked, and it, from their perspective, it works. So why do I need to make any changes? Well, if you were to compare two identical businesses, they have the exact same financial performance, but one has an owner that is deeply involved in every single decision that is made, and in order to get that financial performance. And the second business, the business owner has transitioned all of that knowledge already to other people that are working at the business and to documented processes so that other people can run the business. That second business is more likely to get a higher valuation than the first business, because the buyer comes in already looking and saying, okay, well, this is a well-run business. The improvements I make will hopefully increase the revenue, increase the financial performance. Whereas for company A, they have to come in and first get all of that transition and clean things up. And that's going to take longer before they start to realize a return on their investment. So again, having a well-documented and articulated process and staff that are accustomed to making decisions that are critical to the success of the business is only going to help. Ultimately, due diligence readiness is something that you do before the transition occurs. And it ultimately will protect value and help, in many circumstances, help generate a premium on the business that is defensible when you're negotiating with the buyer on how to sell or what the price is that you're going to get for your business.
Okay, you had a lot in there that I want to kind of dig into even more. So say an owner has come to terms mentally, they're ready, they have the knowledge. Maybe they're A, they're holding on to that knowledge. Maybe they're B, like you mentioned, and they've started already imparting that knowledge to their staff. Maybe they've talked to you. They've taken those first steps. What should they be doing next to prepare that next generation, whether it's a family or the management team, to start taking over?
There are a few things that I have seen promote success in the long-term success of the transition. The first is that the business owner will start to give real responsibility to the people that are going to take over. They will give them responsibility for a lane or a facility or a division of the business that can be measured in terms of what their success is. Another thing that happens, or that I've seen promote success, is to expose the person or the people taking over to the whole business and not just the part that they're used to running or that they're most comfortable in. Somebody who is really good at operations, if they're going to take over, they're also going to need to know finance. They're also going to need to have key relationships. They're also going to need to know compliance. Like, those are things that they have to get involved in. And if they do it when the business owner is still present, then it will help to transition that information. A third thing that I think promotes success is bringing the successors into key relationships early. Introduce them to key customers, brokers, lenders, insurance providers, any third-party stakeholder that has an important role in the business. Make introductions early and deliberately, because relationships transition based on, typically relationships, the strongest relationships are based on trust. And so being able to introduce somebody early on in the process and help them establish trust with these key external stakeholders is a critical piece to a good transition. Also, give them room to make mistakes, to make decisions, including mistakes, and doing that in an environment where the business owner is still present. I mean, that's probably an area where business owners struggle the most, watching people do things differently, or watching them make mistakes they know are going to happen.
I feel that.
Regularly, yeah, I know. It's but at the end of the day, it's how good decision making and good judgment is developed.
Yes.
And so doing it in an environment where there is a safety net because the business owner is there to help them through whatever the mistake ultimately is going to be. And if it's going to be a critical mistake, then it can be identified up front. But having the discipline to be able to step back and say, I'm going to let you make this decision. I can see that decision is probably going to cause 3 or 4 problems. But I dealt with those 3 or 4 problems. I made it through. I trust that you can make it through too. And if for some reason you need help, I'm here to help you.
A life lesson.
Exactly. Yeah. And as I've said before, an important ingredient here is to put everything in writing. Have a plan. Know the timelines. Know the milestones. Who's accountable for what, and ensuring that there's no confusion on how it is that things are intended to play out. I mean, the best laid plans always have some variation to them, but you got to have a plan first.
Okay, so we've talked about preparation. We've talked about someone who's going through a succession plan and being responsible about it. Let's flip the narrative a bit. What are some of the leadership mistakes that can take place during this time?
Well, some patterns that I have observed are the business owner letting go of the title, but not of control. So, I mean, it's one thing to say, I'm going to step back and retire, but it's another thing if you keep showing up at the office every day and expect to be involved in all the conversations and, quite frankly, to have your, decision-making be the decision-making.
Yeah.
I think fighting the urge to do that and taking, so it's totally, most successful plans do include some element of sticking around to be a mentor, but just, bearing in mind that that's the role, not the decision-making role. Another thing that I've observed is doing things too abruptly. And as we've talked about already, just showing up at the end of the road and saying, hey, I'm going to make these introductions to you. Here's so-and-so, and here's, my key customer, and here's the people that are going to be around to help you the most, and here's how I've used them, and, handshake and good luck. That's not promoting a great process.
Yeah.
And I think the third thing or pattern that I've seen, and I've touched on it, or we've touched on it already, is just the emotional toll and not being prepared for what it means to take a step back. And so again, getting the people around you as a business owner involved early enough so that they can help support through the transition process, I think is a key ingredient, but a pattern that if not done would cause problems.
So let's stay with that emotional toll and how that aligns with legacy. In everything that we've talked about today, how can owners protect that legacy and their employees throughout this whole process?
That's a good question. There's sort of 2 parts to it. The first being legacy. It's one thing to have good or great financial statements and great operating procedures. But if you really want to preserve your legacy and the values and the standards that you have developed in the business, a good idea is to document it. Like come up with a 1-page playbook, on this is how we do things here. Because that will be a written document that can be passed on to the next generation or the successor and be a guiding light, kind of a North Star for those that are carrying on in the business. It's also important to put a governance structure in place. Again, if there's going to be 2 or more shareholders, having a shareholder agreement that will help with decision making and help with share transitions if and when the time comes. That framework can also be a reflection of the values that were established by the business owner through the way that decision making occurs and the people that are involved in decision making. And finally, as I touched on, it can be really helpful for the business owner to stay on an advisory capacity or a mentorship capacity for some period of time afterwards. And so as they step back, they're still there to, provide a guiding hand on how to get things done in a way that is consistent with the values and the standards that they themselves, instilled in the business while they owned it and were heavily involved in it. Then the second piece of that is the employees and how to take care of them. And so, one thing is communication. The failure to, as as time goes on, employees are very intuitive, and so they will see subtle changes, and if those subtle changes or those changes in behaviors or things that are happening around the business start to occur and there's no explanation for them, then that's sort of a breeding ground for anxiety and stress and the rumor mill to get going. So it's certainly a sensitive area. You don't want to disclose too early, but at the same time, once there's a plan that you're confident in, arranging to disclose to employees what it is that's going to happen so that they are involved, or at least have visibility or transparency into what it is that's going to happen so that you can avoid the rumor mill is a really helpful thing to plan for. If it's a succession plan that's going to be pursued, then having the arrangements in place so that job security is preserved, ideally no changes to employment arrangements are being made, can be really helpful. It can be really difficult to make changes to employment arrangements, and so the ideal state is that you don't have to make anything, but sometimes the financial circumstances are what they are, or the successor has plans and they are what they are. But to the greatest extent possible, if you can maintain a stable, consistent work environment, I think that goes to promoting employee retention and looking after employees. And if it's a sale process, to the extent possible, if you can negotiate employee retention or an arrangement with the buyer so that as few changes, again, to the employee relationships or the state of not letting people go, quite frankly, is critical. And often buyers are looking for a stable workforce. They're interested in participating in that process so that employees do feel valued or do feel like that there aren't going to be changes and it's going to be business as usual for some period of time. And then we're hopefully going to see the changes that we see will be improvements that will help us, do our jobs better or improve the performance of the company or whatever the case may be. Ultimately, legacy and employee protection go hand in hand. And a lot of this is sort of a reputational circumstance, and the reputation of the business that is transitioning is maybe one of the greatest assets that is going across, and being able to, or working with employees and working with buyers in order to have a transparent and fair process is often what will lead to the reputation of the business owner passing through sort of unaffected, and ultimately lead to sort of leaving a great legacy.
Really important takeaways there. We have covered a lot of ground and a lot of information. As we're winding down, if listeners only remember one takeaway from today's conversation, what would you want that to be?
I think the key takeaway is that succession planning is not a document. It is not a project that has to be done at the end. It's really an ongoing state. And the main risk is not doing it imperfectly, but not giving yourself enough time to do it. And so, again, if you're a business owner and you're listening to this today, it's important to know that the best time to have started succession planning was years ago. But the second best time to start succession planning is today. And so if this is resonating with you, I would strongly encourage you to reach out to your advisors to start the discussion around how to get it done. And that advisory team, I think, includes a corporate lawyer that has succession or M&A experience, your accountant, and if you don't have the internal regulatory expertise, then a regulatory advisor that can help on the compliance side of things with the cleanup activities that may be required. If you know that you want to sell the business, I would also strongly encourage business owners to speak with an M&A financial advisor that can help with the process. Ultimately, I would say that the best business transitions are done by owners who recognize that it is something that they need to do continuously and don't sort of plan for it as being a problem that they need to solve on their way out the door.
So I'm going to throw one more at you, kind of jazz my brain. When I'm starting to think about, I don't know if I want to retire, but I'm starting to think about it, is that a time that I would bring someone like yourself in just to be like, hey, I'm starting to have these thoughts. What are my next steps?
Absolutely. It's amazing how much a short conversation can change the way in which owners are thinking about transition. And you could be sitting there thinking, oh, this is 10 or 15 years off in the future. But that's still an okay time to have the discussion because you know that it is coming. The one certainty that we always have is time.
Exactly.
So at some point, this is going to become a reality. And giving me a call and having a 30-minute conversation about what that process looks like and what some of the milestone events are along the way can completely change the framework in which you're working because you're looking for particular things to occur. And there are things that we can't plan for. There are life events that, sneak up on us and can cause surprises. And so having an awareness of what is coming up and what to look for or what to plan for can help get preparations going and maybe be in a near transition ready state at kind of all times so that if one of those events happens, it's a much simpler process to keep the business up and running with whoever needs to take over, as a consequence of that event.
Boy Scouts, Girl Scouts, be prepared.
Totally.
Sean, thank you so much for your knowledge today. And thank you for coming in studio. We love it when people come to visit us. If people do have more questions, need more information, may we share your information on our show notes?
Absolutely. I'm always happy to have conversations.
All right. Wonderful. Thank you so much.
Okay. Thanks, Kelsey.
All right. Let's close with some news. Speaking of Sean MacLachlan, he'll be joined by colleague Robert Law in presenting Signing, Writing, and Negotiating Contracts for the Commercial Transportation Industry, What to Know to Protect Yourself, at our September 9th regional, our first back from the summer hiatus. So stay tuned to our socials or website to make sure you register for that. Speaking of registration, be sure to sign up for our White Court Safety Summit. That takes place October 1st. As well, registration is officially open for our October 15th Drawdown Dinner. That takes place at the River Cree Event Center in Enoch, Alberta. And saving the date ahead to 2027 on April 7th and 8th, it's our 89th annual conference, and that is taking place at the River Cree Resort and Casino. Do you have any questions or comments about Steering Change episodes? Please do reach out on our Instagram at AMTA_CA or LinkedIn and Facebook at Alberta Motor Transport Association. Stay safe and see you next time.
Thank you for listening to this episode of AMTA's Steering Change podcast. The views expressed by guests of the Steering Change podcast are their own and may not reflect the views of AMTA, its hosts, or sponsors. Did you have a question that you would like answered on an upcoming episode of the Steering Change podcast? We want to hear from you. To submit a question to the Steering Change mailbag, hit up our DMs on LinkedIn, Facebook, or Instagram with the hashtag Steering Change, and your question will be answered either live on the podcast or by one of our SMEs here at AMTA. We ask that you share this episode with those in your network that could benefit from what we discussed today, and make sure to subscribe to our podcast on your favorite podcast platform so you can be notified when future episodes are released. You can learn more about us and our mission by visiting www.amta.ca. Now get out there and have a safe day.